Here's the uncomfortable truth most financial advisors won't tell you. Both credit unions and big banks are playing a game designed to profit from your money. And most consumers don't understand the rules well enough to play strategically. The difference isn't moral. It isn't about one being evil and the other being virtuous. It's structural, mathematical, and completely measurable if you know what to look for. Over the next several minutes, I'm going to walk you through 5 critical distinctions that most people miss entirely, and I'm going to show you how to think about this decision the way someone who analyzes patterns would think about it, not the way a confused consumer does. When I was building mathematical models for financial markets, we had a saying, garbage in, garbage out. If you start with the wrong assumptions, your conclusions will be worthless, no matter how sophisticated your analysis. Most people start the bank versus credit union question with terrible assumptions. They assume bigger is safer, or they assume cooperative ownership automatically means better service, or they assume that the institution their parents used is still the best choice decades later. These assumptions aren't based on data. They're based on mental shortcuts that our brains use to avoid the hard work of actual analysis. So here's the framework I want you to adopt. Every financial institution exists to perform certain functions: holding your deposits safely, providing access to your money when you need it, offering credit products like loans and mortgages, and generating returns on the capital you've entrusted to them. The question you should ask is not which type of institution is philosophically superior, but which specific institution performs these functions most effectively for your particular situation at the lowest total cost. That's a question you can answer with data. That's a question that has a correct answer if you're willing to do the work to find it. The first fatal mistake people make is confusing ownership structure with personal benefit. Credit unions operate as member-owned cooperatives. When you open an account, you become a partial owner. Big banks are stockholder-owned corporations, and you're a customer, not an owner. On the surface, this sounds like credit unions have an obvious advantage. Ownership feels good. It feels democratic. It feels like you're finally on the inside of the financial system instead of being exploited by it. But feelings are not data, and this is where most people stop thinking critically. I often found that the narrative everyone believed about a particular investment was completely disconnected from its actual performance characteristics. The story felt compelling, the thesis made intuitive sense, but when you ran the numbers and looked at historical performance, the story fell apart completely. Credit union membership follows a similar pattern. Yes, you're technically an owner, but what does that ownership actually give you in measurable terms? In most cases, it means you get to vote for board members you've never heard of, making decisions you'll never understand, affecting outcomes you can't measure. The ownership structure sounds empowering, but for the average member holding $1,500 in a checking account, it's functionally meaningless. Now, does this mean big banks are better? Absolutely not. What I'm saying is that ownership structure alone tells you almost nothing about whether an institution serves your financial interests. You need to dig deeper. You need to measure actual outcomes: interest rates on savings, fees charged for services, loan rates offered, quality of customer service, technological infrastructure, and financial stability. These are things you can quantify. These are what matter. The ownership model is just the framework. It's not the result. Here's a concrete example of how to think about this in numerical terms. Suppose Credit Union A offers you a savings account with 1.2% annual interest and charges you 0 monthly fees. Bank B offers you 0.5% interest and charges you $12 monthly in fees unless you maintain a $5,000 minimum balance. Over 1 year, if you maintain an average balance of $3,000, Credit Union A gives you $36 in interest. Bank B gives you $15 in interest, but takes $144 in fees, netting you negative $129. The difference in ownership structure is philosophically interesting, but the difference in your actual account balance is $165. That's the number that matters. That's the data point you should care about. But let's go deeper into what ownership structure actually affects. In a credit union, because members are owners, the institution's legal obligation is to serve member interests. In a publicly traded bank, The legal obligation is to maximize shareholder value. This creates different optimization targets. A credit union should theoretically optimize for member benefit. Lower fees, higher deposit rates, lower loan rates, better service. A bank optimizes for profit. Higher fees, lower deposit rates, higher loan rates, whatever service level maintains customer retention while minimizing costs. In practice, this distinction matters, but not as much as you might think. A well-run credit union does tend to offer better pricing on financial products. Industry-wide data supports this consistently. But a poorly run credit union can offer worse terms than a competitive bank, and a bank trying to gain market share might offer promotional rates that beat credit union standard rates. The ownership structure creates an incentive framework, but it doesn't guarantee outcomes. You still have to look at the actual numbers for the specific institutions you're considering. Here's another dimension most people miss entirely. Ownership structure affects how institutions respond to financial stress. During the 2008 financial crisis, big banks that were failing got bailed out by the government because they were deemed too big to fail. Their shareholders were protected, their executives kept their jobs, and taxpayers bore the cost. Credit unions, being smaller and more numerous, don't get this treatment. If a credit union fails, it gets taken over by regulators, and while your deposits are insured up to the federal limit, the institution itself disappears. This might actually be a healthier system because it maintains consequences for bad management, but it also means you need to pay attention to the financial health of your credit union in a way you might not worry about with a systemically important bank. The second major mistake is assuming that bigger always means more stable, or that smaller always means more personal. People stick with big banks because they assume size equals security. There's a psychological comfort in banking with an institution that has $1 trillion in assets and branches in every state. It feels too big to fail. And after the 2008 financial crisis, that phrase took on a very literal meaning. The government proved it would bail out massive banks because their collapse would have destabilized the entire economy. But let's examine what safety actually means in this context. Both credit unions and banks are insured by the federal government. Credit unions are insured by the National Credit Union Administration up to $250,000 per depositor. Banks are insured by the Federal Deposit Insurance Corporation, also up to $250,000 per depositor. Mathematically, your insured deposits are equally safe in either institution up to that threshold. The size of the institution is irrelevant to your principal protection for amounts under the insurance limit. Where size does matter is in the range of services offered and the sophistication of technology platforms. Big banks invest billions in mobile apps, fraud detection systems, ATM networks, and integration with other financial services. If you need to wire money internationally, get a cashier's check at midnight, access a branch while traveling in another state, or integrate your bank accounts with sophisticated financial management software, a big bank's infrastructure often provides more options. Credit unions, especially smaller ones, may lack these capabilities. They may have limited hours, fewer branches, less sophisticated apps, and slower adoption of new technologies. But here's where it gets interesting from a data perspective. Many credit unions have formed cooperative networks that allow members to use thousands of ATMs nationwide without fees and to access shared branching where you can conduct transactions at other credit unions as if they were your home institution. From a pure functionality standpoint, a well-connected credit union can offer nearly the same convenience as a big bank for most everyday transactions. The question becomes, what's your actual usage pattern? And this is where most people fail analytically. They imagine what they might need rather than looking at what they actually use. Let me give you a practical example. You might think you need international wire transfer capability because you travel abroad occasionally. But when you look at your actual transaction history, you've sent exactly 0 international wires in the past 5 years. You use a credit card abroad and maybe an ATM for local currency. The international wire capability that feels important is solving a problem you don't actually have. Meanwhile, you're paying higher fees and getting lower interest rates for access to a service you never use. This is unclear thinking, and unclear thinking costs money. When I was running Renaissance, we had a principle: measure what matters, ignore what doesn't. We didn't make investment decisions based on what might happen or what felt important. We looked at what the data showed actually happened, what patterns actually existed, what variables actually predicted outcomes. You should apply the same principle here. Pull your last 12 months of bank statements, count how many times you went to a physical branch, count how many times you used an ATM, count how many times you needed a service that only a big bank provides. Most people, when they actually do this exercise, discover that 90% of their banking happens through direct deposit, online bill pay, and occasional ATM withdrawals. For that usage pattern, credit union infrastructure is perfectly adequate. The third critical distinction involves the profit motive and how it affects pricing. This is where credit unions often do have a legitimate structural advantage. Credit unions are not-for-profit organizations. This doesn't mean they don't make money. It means that profits are returned to members through higher interest on deposits, lower interest on loans, and reduced fees. Big banks are for-profit corporations that must generate returns for shareholders. This creates a fundamentally different incentive structure. A big bank is optimized to extract maximum profit from customers while retaining their business. This leads to strategies like offering promotional interest rates that drop after 6 months, charging overdraft fees that generate billions in annual revenue, and creating complex fee structures that most customers don't fully understand. These aren't moral judgments. These are rational business strategies for a profit-maximizing entity. If you own stock in a big bank, you'd want them to do exactly this. Credit unions, by contrast, are optimized to provide value to members because members are the owners. There's no separate shareholder class demanding profit extraction. This often results in measurably better terms on financial products. Industry data consistently shows that credit unions, on average, offer higher interest rates on savings accounts, lower interest rates on loans, and significantly lower fees than big banks. The numbers are clear on this. We're not talking about small differences either. We're talking about differences that compound into thousands of dollars over time. Let me give you a real-world mathematical example. Suppose you're taking out a $30,000 car loan for 5 years. Credit Union A offers you 4.5% interest. Bank B offers you 6.2%. These might seem like small numbers, just a 1.7% difference, but let's run the actual math. On a $30,000 loan at 4.5% over 60 months, your monthly payment is $559, and you'll pay about $3,570 in total interest. At 6.2%, your monthly payment is $581, and you'll pay about $4,840 in interest. That's a difference of $1,270 for the exact same car, the exact same loan term, simply because of where you chose to borrow. Now, multiply that across multiple financial products over a lifetime. A mortgage with a half-point difference in interest rate on a $300,000 loan costs you tens of thousands over 30 years. Credit card interest rates that are 3 points lower save you hundreds or thousands annually if you carry a balance. Checking account fees of $15 monthly versus zero fees is $180 per year, every year, forever. These differences compound. They accumulate. They represent real wealth transfer, either into your pocket or out of it. Here's what's interesting from a decision theory perspective. Once you know these mathematical differences exist, the choice becomes much clearer. If you qualify for membership at a well-run credit union, and that credit union offers the services you actually need based on your documented usage patterns, and the pricing is measurably better, then switching is a rational decision that puts money in your pocket. The emotional attachment to your big bank, the inertia of not wanting to change direct deposits and bill payments, all of that is costing you real dollars. But here's a question a rational person might ask. If credit unions are so much better on pricing, why doesn't everyone use them? This is the right question, and the answer has several components. First, not everyone qualifies for membership. Credit unions have membership requirements based on geography, employment, organizational affiliation, or family relationships. You can't just walk into any credit union and open an account the way you can at a big bank. Second, many people simply don't know these differences exist. Financial literacy in this country is remarkably poor, and most people choose banks based on convenience, familiarity, or where their parents banked. They've never done a cost comparison. Third, big banks spend enormous amounts on marketing and have superior brand recognition. You see their commercials during football games. You see their logos on buildings. You associate them with stability and success because they've spent billions creating that association. Credit unions, with their limited budgets, can't compete on advertising spend. Fourth, switching financial institutions is genuinely inconvenient. You have to change direct deposits, update all your automatic bill payments, get new account numbers, new debit cards. It's a hassle. For many people, the psychological cost of that hassle exceeds the perceived benefit of saving a few $100s a year, even though rationally, a few hours of setup work to save hundreds or thousands annually is an excellent return on time invested. The fourth mistake people make is ignoring the quality of financial advice and customer service. This is harder to measure than interest rates and fees, but it matters enormously over time. Big banks primarily interact with customers through call centers and branch staff who are often undertrained, overworked, and incentivized to sell products rather than provide genuine financial guidance. I've seen data showing that bank representatives frequently recommend products that benefit the bank more than the customer. This isn't because these employees are malicious, it's because they're operating within an incentive system that rewards sales. They have quotas, they have metrics. They get bonuses for opening new accounts and selling credit cards, not for giving you advice that minimizes your costs. Credit unions, especially smaller community-focused ones, often provide more personalized service. The staff may actually know your name, understand your financial situation, and offer advice that's tailored to your needs rather than their sales quotas. There's a meaningful difference between calling a 1-800 number and speaking to someone reading from a script versus walking into a local branch where the staff recognizes you and understands your history with the institution. These relationship factors have value. They reduce friction in transactions. They make problem resolution faster. They create accountability that doesn't exist in anonymous customer service interactions. However, let's be honest about the limitations. Neither credit unions nor big banks are in the business of providing sophisticated financial planning for free. If you need serious wealth management advice, investment guidance, tax optimization strategies, or complex estate planning, you're going to need to hire a professional. The question is whether you get basic, competent service for everyday banking needs and whether the institution's incentives are aligned with helping you or extracting profit from you. I built my career on removing human emotion from decision-making and letting statistical patterns guide strategy, but I'm not naive enough to believe that customer service quality doesn't matter. It does, especially when things go wrong. When your identity is stolen, when a fraudulent charge appears, when you need a mortgage approved quickly, when there's an error on your account that needs immediate resolution, the quality of the people helping you can make an enormous difference in outcomes. This is difficult to measure in advance, but you can look at customer satisfaction surveys, online reviews, complaint data from regulatory agencies, and resolution statistics. These aren't perfect measures, but they give you information about what kind of experience you're likely to have. Here's a framework I use for evaluating service quality. First, look at the incentive structure. Are the people serving you rewarded for solving your problems or for selling you products? Second, look at the accessibility of decision makers. If something goes wrong, how many layers do you have to go through to reach someone with authority to fix it? Third, look at historical performance data. How does this institution handle complaints? What's their track record? Fourth, test the service before you fully commit. Open a small account, conduct a few transactions, call customer service with questions, and see how the experience feels. The Fifth and perhaps most important distinction is about financial alignment and long-term thinking. Big banks operate on quarterly earnings cycles. They're pressured by shareholders and analysts to hit revenue targets every 3 months. This creates short-term thinking and incentivizes strategies that boost immediate profits, even if they harm customers or long-term stability. We saw this play out catastrophically in 2008 when banks created and sold financial products they knew were toxic because it generated short-term bonuses and stock price increases. Credit unions don't face the same quarterly pressure because they don't have stock prices to maintain or shareholders to appease. This allows for longer-term strategic thinking and more stable conservative management. Credit unions are far less likely to engage in risky investment strategies or aggressive lending practices because there's no incentive to boost short-term returns for external investors. For a depositor, this means your institution is less likely to blow up spectacularly, but it also means they might be slower to innovate or adopt new technologies. Here's how I think about this, as someone who spent decades managing risk in financial markets. Every financial institution exists on a spectrum between aggressive growth and conservative stability. Big banks, driven by profit demands and shareholder expectations, tend toward the aggressive end. They want growth, they want revenue increases, they want to expand their customer base and their profit margins quarter after quarter. This creates opportunities, but also